Welcome, guys. Today we are going through the unlocking hidden tax benefits that can boost your cash flow. And I know that it's not necessarily a topic that gets us super excited. It does me, because why work harder when you can just work smarter? So we've got Bonnie on today, who's one of our experts. So we will go ahead and do some introductions and then dive in. Which first we will actually do a question. So on a scale of 1 to 10, how much do you look forward to tax season? And Seth, do we have a poll for this one, or is this one just something for them to throw in the chat? And
It's just something that they can write number.
okay,
1 to 10.
awesome. 1 being not at all, 10 being yes, I do. I personally actually really enjoy tax season because of the prep that I do with my team in Q4 of the year before. But I know for a lot of people, it's a very challenging time where you're gathering all this loose paperwork that's in different spots. You don't know how much you might end up owing. You don't know if you've taken the most advantage of your properties and what you've been doing the prior year. So that's part of what we want to help clean up for everyone today. So diving into intro. So I'm Kristi Kandel, and I'm one of the co-founders of Local Real Estate Developers. I started in a small town in Ohio. I grew up there, a town of 2,500 people. And after college, I ended up lucking into the real estate development world. My first job was with a sign company, which was putting up signs for CVS Pharmacy. And I got to meet all of the developers who were working with CVS and got to see that, wow, like the developers are the ones who are building our cities and they're the ones creating these awesome new spaces. And I wanted to be part of that. So I ended up working on deals in Florida. I got the opportunity to go out to Southern California and work on projects from San Francisco down to San Diego. And in 2015, I then took the leap and started my own company. So we do development and consulting. I ended up taking the money that I made from that and then investing in my own portfolio of single family duplexes, quads, and then larger multifamily. And now we're at the point today where it's time to empower you guys. I really get a lot of joy and excitement from working with others to help show them that ordinary people like you and me can actually be the developers redeveloping those neglected properties in our small towns. And we can be the ones who are creating these awesome spaces for people to live, work, and play. So now at this point, I want to take my 50,000 hours of experience and give it back to everyone to really help transform our communities. So this is just one of the things that we're going to share along the way from a tax standpoint, but we just want to add value to those out there. And this applies to your smaller properties. It applies to development, and Bonnie is definitely the expert. And then our other co-founder is Lynn, which we gave her a hall pass today because she is neck deep in her own development deal, working with a potential investor to do phase 2 of their project. And we will actually be doing a live video, might not be live, it might just be a recording, but in a couple of weeks, we'll be up there together seeing all the progress that they've made at her property. And we'll actually be staying at their first development, the Fresh Coast Cabins, to try and catch those northern lights. So stay tuned for that, guys, when it comes across. And now for our special guest, Bonnie, go ahead.
Well, I'm so glad to be here, and thank you, Kristi, for inviting me. I'm also a seasoned real estate investor, commercial broker, but my license is inactive at this time. I've divested of most of my commercial properties at this point in my life so that I could play more. But I do have one residential rental that I still maintain. And I love working with people to help them minimize what they have to pay in taxes and leverage that so that they can purchase more and do more. And so working with CSSI has really brought that about. And so I love meeting with you today and going over some of the things that you can do to help you leverage what the possibilities are. Okay.
Love it.
Change the slide.
Yeah, so this is our overview of what we'll get into. So we'll go through, just do a high level introduction of tax benefits and cash flow opportunities, go through different depreciation strategies. And some of this is what you guys will be familiar with because I know some of you have done your own cost segregation studies. But then we're also going to include the next level. And so don't get too concerned. And actually, if you want to go ahead and flip it to the next slide, if you guys want to get this free resource, we just want to give you guys something that can help you along your way in your journey. But look at this tax portion, kind of how you look at asset protection. You don't need to know it all from the start. You don't need to be the expert, and it won't all apply to you right away. But the good thing about this is you'll probably get some nuggets where you can go, oh, we can do that now on this short-term rental or this BRRRR or this flip that I'm doing. And now I know for the future, when I do this type of project, I can apply these strategies. So don't let this overwhelm you. It's why we have awesome people like Bonnie to share this with us, but then also work with us and our CPAs to make it happen on our deals. And then just let it just have some information come in that you can use in the future. So let's go ahead and get started.
The most important word, as Guy Kawasaki or Robert Kiyosaki, if I can say it correctly, in the world of business is money and is cash flow. And cash flow is critical to the success of any business endeavor, whether it's real estate investing or building your own business. But the second most important word is leverage. And that's what I give clients, is being able to leverage cash flow and get that into a better performing way of using it. Now, you could also take a vacation. If you had an extra $50,000 or $1 million, which is not unlikely, a lot of things can be done with that. So let's switch to the next slide here. Okay. So why, getting that extra cash flow is critical for most people. And there are ways to get $1 million on every 10 million you invest. But even a residential rental may have probably 8 to 10% of what you paid for that property available for you in cash flow. And that could be the first year you do this. So let's turn the slide.
All right, let's dive in.
Okay. So cost segregation, as some of you may know, is accelerating your depreciation. Now, back in 2017, you were able to get as much as 100% bonus. And that went through 2022. Now it's dropped in 23 to 80% and 60% in 24's taxes. Now that may change again, because with a change of administration, we may get, and very likely will get, this cost segregation at 100% back again. And that's regardless of which party ends up in the White House. And the reason I say that is because the House passed it overwhelmingly by Republicans and Democrats. But when it got to the Senate refused to approve it because it had a child tax credit attached. So coming next year, I think you're going to see this pass to go back to 100% bonus depreciation starting in 2025. They're not going to go back and retroactive it to 2023 or, so don't count on that, or 24. But I think that we can look at it as 25, you're going to get this bonus back again.
And do you see this as being something that now that we have it, that we will possibly continue to have it in some form, or do you see this eventually phasing out? Just using your crystal ball and your best guess.
My best guess is they'll never phase it out completely. And that's because prior to us going to 100% bonus depreciation, it was actually down to 50% bonus. So I think that we're not going to see it go away, because it really spurs development. I mean, if you have an extra $50,000 or $1 million in cash flow, I've had a lot of clients turn to their real estate broker and say, find me another property. I want to do something with this 90 grand. Now, again, like I said, you could go on a trip, but that's not going to leverage it for you. If you want to build your real estate portfolio, use it in a manner that you're going to make more than you would normally get by letting it set in the treasury, because you're not getting any interest on it setting with the treasurer for 27 and a half or 39 years.
Mhm.
So this is, you can see here the graph. If you look at the green, that is where the 100% bonus comes in. And the red is, you know, what you would get with a lesser percentage, but it's just accelerated. So just by doing the cost segregation, if there was no bonus at all, you know, if we do cost segregation, you're looking at that red line. You're still pushing it forward. So you have the cash flow in the early years. That's what you want as an investor. So, and you can go back to a property that was purchased in even as far back as like November of 2017 and get your 100% bonus. So it is retroactive in that respect. That's if you bought the property in a previous year, the benefits go based upon the year you purchased and occupied that property, not on the day you file the cost segregation. The
Yep,
only difference
exactly.
is, yeah, it's really a benefit for everybody. So don't hesitate to give me a call and say, look, I bought this property in X year. What's my available depreciation, or what can I expect? Estimates are free of charge. They're very, very accurate. So, you know, don't hesitate. If you have questions beforehand, I'm available to talk to you. Okay.
I love it.
So
And as we're
hopefully
going
that
to the
explains.
next, yeah, as
Yeah.
we're going to the next slide, I ended up doing that because my first CPA was not necessarily super versed in real estate. And when I ended up switching CPAs, we went backwards on a couple properties, and whoo, it opened my eyes up to go, wow, like there are incredible ways that we can do this now. And I did exactly what you said. And I took, in that case, it was a couple $100,000, and then bought several more cash flowing properties as a result that could also use cost segregation. And that just became the snowball effect.
Yeah. Yeah. And you want to make sure that when you do cost segregation, you find a reputable company that is going to back you for any audits for as long as you own that property. Now, we do it as long as you own the property plus 3 years, because that's how long the IRS has to audit you. And our audit protection or defense is there for you at no cost when you work with us.
Now, will every company do that? Or is that one of those
No.
questions when people are vetting that they need to ask? Okay. So
Yeah.
they should make sure that it's for as long as they own the property. And is the plus 3 years, is that a standard? Will people push back on that, other companies, from what you've?
No, well, yeah, they'll push back on it, but that's the IRS's regulation. I mean, they'll try to, you know, if you read the fine print, I mean, one estimate for you is not the same as another one. Okay, I had a client send me several properties a while back and say, look, you know, this company gave me half of what you're charging. So I went through and I looked at what they were offering. The fine print was loaded with extra fees. There was no additional audit protection. And to top that off, they never looked up the land value. They used a straight percentage, which was lower than any of the properties that they had given me. So, and as all ended up, I ended up with 5 additional properties from the same client because he trusted me. And we did meet the price, but, you know, given, you know, additional for what extra services that we provide that were in the fine print. So,
Yep, exactly. And building that
just
trust
be
right
careful
there,
who
that's
you're working
huge.
with.
Yep.
And a desktop study or do it yourself, what happens is if you ever get audited, they're full of holes. So just be really careful. Okay. A lot of studies are done offshore and you don't even know it. So your personal information is out there.
Yeah.
Cost segregation. Let me go through this particular slide. So you understand how cost segregation works. When you buy a building, whether it's a residential or a commercial, it's based on 27.5 or 39 years. So what your CPA normally does, or tax professional, who is not really real estate savvy, or even those that are, it's easy for them to do straight line depreciation, which takes your property, if it's commercial, is 39. They divide what you bought it for minus the land, and they divide that by 39 or 27.5. And each year you get 1/39 or 127.5 of what you're entitled to over the life of that property.
And can you
So-
explain the difference in when it would be 39 or 27.5?
Sure. A commercial property is based on 39 years. Now, a short-term rental is also based on 39 years. And I would see the majority of federal depreciation schedules on short-term rentals done wrong. That's a red flag for the IRS. So 39 years is what your short-term rental should be based on. If it's 30 days rentals on average or more, then it goes into the long-term rental for residential, which is 27.5 years. So just
Thank
keep that in mind, because if you go back and review your depreciation schedule, my guess is the majority of you will find out it's done wrong. That's what we find. So instead of taking straight line, which is 1/39 or 127.5, what we do is we break it out into the base building, which is the structure of that building. Okay. And that's gone. Land, we can't depreciate land. The structure goes on to depreciate for the 39 or 27.5 years. So you still have depreciation coming. It's just we pull out the 5 and 7 year property, and QIP, which is for commercial properties, qualified improvement properties, and the 15 year, which is land and improvements, land improvement, even trees, driveways, signage, all of that. Okay, you can go to the next slide. Okay, so this is what comes under each of those categories. So the base building is all these things that normally we cannot deduct up front. This goes into capitalized items, which is part of the structure of the building, and of course the land. So the tangible property, which is the 5 and 7 year that we can bring it down to and get you up front, is the decorative molding, carpeting, window coverings, sometimes special security systems. And then if we skip over the QIP, go to land improvements, parking lots, striping, asphalt, concrete, landscaping, like I said, trees, bushes that you've got in there. All of this is depreciable up front with the bonus depreciation, or over 5 and 15 years, instead of waiting 27.5 or 39 years. So you want cash flow? This is what's going to give you the cash flow to leverage to increase your ROI and your profitability as a business and an investor. Don't overlook it. Okay.
Yes.
You can go to the next
This
slide.
is huge.
Okay. When you get a return from us, after we do a study for you, if you decide to go with us once we give you the free estimate, what you're going to get is a breakdown of the property for your CPA, so that they know here's what comes under the 5 year, the building components. I'm sorry. These are building components that actually go under the 5 year. Security systems, canopies, awnings, interior overhead doors, security, all of these things go into the 5 year bucket. And we specify exactly what each of these is under that category. The site work improvements go into the 15 year category. So remember, I said 5 and 15 year sometimes can be taken up front with bonus, and the rest of it will go over the 5 and 15 years. So this is what's divided out by your CPA once they get this and decide, okay, do I want to take all of this bonus this year, or do I want to push it forward because you don't have enough to cover it all? and you can roll it forward, by the way. The building structure is separate. This you don't get bonus depreciation on or upfront depreciation, but this goes on to depreciate over the 27.5 or the 39 years, okay? And sometimes this can change down the road, and I'm going to talk about that as well. So Kristi, you could change it if you'd like. Okay, this is the input doc. Whoop, building systems. Here we go. Building systems. Go back one. Here we go. We provide you a building systems analysis. Now, why is this important? Well, these are the building components that are in 27.5 or 39 years. And this is separated out because right now the depreciable cost is on that left column. On the right column is the current replacement cost. Now, let's say you're doing a roof, okay? And you have to pay for it. Insurance is not, okay? What happens?
Just had that happen at a fourplex in Reno. Do tell.
Okay, so what happens with a roof replacement is that normally they're not totally replacements. It's usually the shingles or just the underlayment, which is less than 40% of what the total roof replacement would be, which would be all the way down to the studs. But most of the time, unfortunately, it gets lumped into the category here under capitalized improvements. So if it's less than 40% of this current replacement cost that we've outlined on the right side, then you can expense it. Done.
Ooh, how do you get to that current replacement cost? So for a real life, and it was actually a roof in Tahoe. It's they're going to end up putting the layers on top because of the type of roof it is. So they're going to just put additional layers on, and it'll cost us 10 grand. But how do you come up with what the current replacement cost is so we can see if it's at that 40%?
Actually, what you just described is a repair, which can be expensed.
Which is kind of like, as I was saying that's not, okay.
So that's why it's important, even if you've owned a property for a while and you're going to do some major changes to it, you know, a phone call, a quick email to me, and I can give you some information like this that's going to save you a lot of money. So that 10 grand, instead of what your CPA or tax pro is probably going to do, you can expense it because you're repairing it. You're not replacing it. Okay.
Excellent. This is already making me money.
All right. See the reason you invited me here, right?
Okay. Many reasons.
So
You're
anyway,
such a
hope
wealth
that
of information.
On most items here on the replacement cost, it's 35% or less. But with roof, it's different. Roof is under 40%. So if whatever you're doing is under 40% of the total replacement cost, it can be expensed. Okay.
Excellent.
Next slide. Okay. Here's how we give you studies. Okay, we're going to give you a conservative and a high end on what you can expect. This was on a residential property. Purchase price minus land was $410,062. And the year we applied this was 23. So in 23, you got an 80% bonus. So that 80% came up front first year. And the rest of the 20% came over 5 and 15 years. So the range of benefits on this for 2023 gave them a tax savings of $26,000 estimated on the conservative side and $37,706 on the high end. This is the way we give you an estimate so that you can gauge. Some people who are paying quarterlies will actually be able to take this number and our estimates, because they are so close, that you can use that to defer your quarterlies before you even file your taxes or do the final study. So that's something you ought to be aware of as well, Because why pay quarterlies and wait for a study to
Mhm.
be done at the end of the next year? You can get the
Do
estimate
you
now.
submit the estimate, or you just have it as backup to prove at the end of the year? How does that actually?
You keep it as backup with your
Okay.
CPA, but you do have to go through with it eventually before
Okay.
you file your taxes. But you know, at least you know that you can defer, you know, some of those quarterlies in advance with justification by having
Yep.
this. That's how close our study or our estimates are. Okay. So, you know, it's just something to keep in mind. Now, I want you to take a look at this, the Airbnb. I've got a whole presentation I do on Airbnbs alone because so many of them are not being done correctly. But even those Airbnbs, again, it could be 39-year property, or it could be a 27 and a half, depending upon the length of your rental term.
Mhm.
And I'll repeat it one more time. If it's under 30 days, less than 30 days, it is a short-term rental and should be done on 39 years. If it's 30 days or more, it has to be done as a long-term rental at 27.5 years. Okay.
And just to make this extra complex, what if for 6 months of the year it was a short-term rental, 6 months of the year you rented it out actually as a 6-month lease? Do you then have the CPA do the math to do those calculations to say 6 months at this?
Yeah, you have to look at what the average
Okay.
rental is. So if that 6 months might throw it off, which means it will be long-term, which is at 27 and a half years instead of 39.
Mhm.
So those are the little details that come up with
Yep.
this that you're not aware of, and a lot of people do because it's seasonal sometimes with the
Mhm.
Airbnbs.
Yep. And this
So-
is again why we have people like you talking to our tax professionals, preparing those so that way, because this at some points just goes whoo, to us,
Mhm.
but knowing how to put the right people together to go, okay, because I know a lot of short-term rental people also end up turning it into midterm rentals, and maybe they get a good person and they stick around longer. So awesome. All
Yeah.
right.
But you know, when they turn them into midterm rentals and they've done a tax filing as a short-term rental, they have to do what's called a 3115 change of accounting form. And CPAs hate doing them. We do them for you and for your tax professional, so that you don't have to worry about that. Don't sweat it. I know we're going through a lot of details here. Just be aware, and know that I work with CPAs all the time. They send me their clients. I teach continuing education for CPAs through, real estate, through CPA associations. So, you know, just give me a call because I teach them about this stuff because most of them are not aware, you know,
Mhm.
and a lot of beginning real estate investors, unfortunately, you know, they're looking for a CPA or a tax professional that will give them a good rate.
Yep.
Okay? They're not usually using a real estate savvy CPA. So we teach those CPAs and even work with your CPA to help you get the benefits that you deserve. Or in a lot of cases, if you've started expanding your real estate investment business, we help you find the right CPA who is real estate savvy.
Exactly, because you will get to a point where you outgrow your prior professionals, and that's a great thing. It's a pain point,
It
but it's
is.
a great thing because it means you're growing and expanding. So that's why we have people like you out there to be the translator and to either pair us with the right person or at least help our current person through that tax season. So awesome.
And you can always ask people like Kristi and others who have been down this road. You know, who do you recommend and why? As far as who do you
And
use?
why?
Yeah, why? That's a good one. Okay. But
Yes.
these properties here, we'll do any of these kind of residential properties. So don't, and I didn't put up commercial here, but you can go ahead and change the slide. Okay. We also work with a lot of commercial properties, and the benefits are tremendous here. So if you own a strip center or other commercial properties, I'm not going into it in detail here, but you know, you know, give me a call and we can talk more about all the ins and outs, because there are a lot of benefits that the owners of these properties are not aware of that are available to them.
What do you think, just to kind of sit on this, because I know a couple of people are looking at some multi-tenant buildings like this. What do you think are like maybe the top 3 or top 5 key things just to put on their radar for what they could benefit from?
Okay. Tenant improvements come up all the time. Okay. And when you buy a strip center like this, the properties that, or the clients, the tenants that are in there now, okay, have already had the improvements done. So you are buying that property with those improvements in place. So when those tenants move out, you can actually do what's called partial asset disposition, and I'll get into that a little bit later, where you actually get tax credits for what's being taken out. Okay? And you also get tax benefits if the owner of this property is the one that pays for the improvements going in.
And that's something, guys, we talk about in negotiating with tenants and the leases, is that who does the work, who pays for the work is all negotiated. It's all part of the contract, and there's pros and cons for both. You want a tenant who can come in and who isn't worried about how they're going to pay rent and to make sure they have a profitable business. So you might structure the deal in certain ways where you cover the tenant improvements, or you provide a TI allowance, or you do the build out for them in exchange for a higher rent in the long run. So there's all sorts of ways to get creative. And part of that comes to talking with people like Bonnie as you're figuring out what is that scenario, because then you can structure it to where, yeah, it might seem like you're coming out of pocket with that money, but when it all nets out, you're actually coming out ahead. So
yeah, it's who has the investment in that property. So, you know, again, like I said, remember that when you buy a property, you are buying all the tenant finish that's already in there. You've paid for it in your purchase price. So why
and is there
shouldn't
something
you
they
get credit?
exactly, and is that something that they should take a video of what the inside of each unit looks like? What's the best way just to make sure they capture what's there for each tenant?
I think before you even do the renovation, I mean, again, every situation is very different, depending upon if you bought it with all those renovations in place, or if you bought it and then you've got a new tenant coming in and you're doing renovations. Who pays makes a difference. So it's best to talk to somebody before making those big decisions about renovation, before you lose the opportunity. Because when I mentioned partial asset disposition, if you don't do it in the year that you do those renovations, you've lost the opportunity to do it.
There we go. Okay, awesome.
Okay.
All right, well, we're coming up to our next poll, and it's a question that many people have said they've not only considered but done on a smaller property. So have you guys ever considered using a cost segregation study? And maybe as they're filling that in, Bonnie, what would you say what's the typical cost difference if someone said, yeah, I just went in and I paid for it knowing that there's all the holes? What's the cost difference in hiring a firm like yours from a comparison standpoint, noting that you're probably going to find them way more savings than a generic study? Is it like $1,500 or $2,500 difference maybe?
Sometimes, depending upon who you're getting the generic study from, it can be extremely different, or it can be pretty close to the same. It just depends on who you're working with. I mean, if you do an online cost segregation and expose yourself to to the audit risk, you know, you're going to pay $500. It's not even worth 500 in my opinion. Okay. But, you know, if you've got a property that doesn't qualify for a more legitimate way of doing the cost segregation or more thorough way, which could be a property that's, you know, let's say you bought it for $100,000 and you didn't do any renovations. It may not be worth going through an engineering-based cost segregation. And I tell people that when they contact me, I ask them the questions that let me tell the client, is this worth pursuing, or is this something that you should do in, you know, some inexpensive way, and you're not likely to be audited.
That's a great analysis of where they feel comfortable doing that quick and dirty $500 one versus a full study. So awesome.
Right.
All right, let's dig into those partial asset dispositions.
Okay. Now, this is unfortunately very overlooked. Let me give you an example that would also translate to some residential type properties. And that is, let's say that you own a franchise for a car dealership. That franchisor requires that every so many years you go in and remodel your entire showroom. That's just part of the deal. Could be a fast food restaurant where you're franchising it from someone. Or it can be a commercial property where you're doing major renovations. You must do this in the first year that you do these renovations. And we can do this study separately from a cost segregation or after you've done a cost segregation in years following when you're doing major renovations. What happens with this is that we take a look at what is currently in the property before the renovations are done. And then look at your depreciation schedule and look at what you're going to be putting in. So what's being taken out is already on your depreciation schedule. But why should you keep it there? I mean, get it off that depreciation schedule because it saves you in taxes. Okay. And some of these things can be actually expensed. So what we're doing here is, instead of having to capitalize, you know, what's been in there, you get to expense it, and then you can capitalize or depreciate the new things that you're putting in, you know, what you've done in renovations. So if you don't do this partial asset disposition in the year that you're doing the renovations, you lose the opportunity to do it going forward. Now,
This
sometimes
is
we
huge
can
for
go
our.
back.
Oh, finish that, yeah.
Yeah. Sometimes, let's say you did the renovations in 23, and you've already done your taxes, or you've extended your taxes. Sometimes we can go back and look at what you did in 23 and file an amendment or help you out with that. But if you wait more than a year, you're not able to do it. Okay. So you lose that opportunity.
This is key for lots of the pads are for lots of our local developers, because they're having situations just like this. But they're not necessarily aware of all of these, nor are their tax professionals. So
That's
yeah,
right.
this is definitely a strategy we're sharing within the community for sure.
Okay, so, you know, it's just, you know, common items like you talked, Kristi, about the roof. You know, if you were actually doing a reshingling or something like that, where you're tearing off what's there now, you know, a different type of property, because what you were talking about is a repair. But if it's a different type of property, and let's say you're removing a roof, what goes in the trash is already on your depreciation schedule. So why not get it off the depreciation schedule before going forward? You know, get it off of there, so you're not continuing to depreciate that and the new roof that you might be putting on. Okay.
Exactly.
So you're losing a lot of opportunities there if you don't do it. Even the LED retrofit projects where you're changing the lighting for energy savings, the
Mhm.
same thing. I mean, if you've got a big warehouse and you're tearing out all the incandescent lighting or the high pressure sodium or whatever you have in that warehouse,
Mhm.
that's on your asset. That's on your depreciation schedule now. If you
Yeah.
don't do this partial asset disposition, it remains on there. So this will get it off your depreciation schedule, and then you can put on the new upgraded lighting system LED and get a lot of the tax credits that are involved with doing the LED as well.
So
Okay. Here's another little strategy here that a lot of people don't know about. I did a depreciation, a cost segregation study on a building that was being turned into a veterinary hospital. And outside of it, they had eight of these air conditioning units, like you see in the picture here.
Mhm.
And what the owner said as they were doing the renovation is, oh, they're going to tear out all these and replace them with new ones. And I said, don't do that. I said, replace 1/3 of them at a time. Because if you replace 1/3 of them every year, you get to expense it instead of depreciating it. If you replace all of them, it has to go on your depreciation schedule as a capital expense. So it's little
Boom.
things
So
like this
are you
can
able
save
to
you.
put just a quick dollar amount to that? I'm just to give them a mental picture of what that did. Just a
I
ballpark.
don't know what the cost would be for replacing all of them, but my guess would be if she replaced all of them in 1 year, that replacement probably would have been $30,000-$40,000. My guess is,
Yeah.
yeah, and she wouldn't have
And they were
had
able.
the ability to get them off the depreciation schedule.
Mhm.
Okay.
Yeah, so unless it was in dire need and they all like they just weren't working and needed replaced. Yeah, this is huge. This is stuff that gets me excited now that would have never gotten me excited before, but just understanding these nuances and how to properly leverage them. It's just like there's these hidden gems that the tax code is so big and the incentives are like so nuanced that yeah, when you find out little things like this, it's just like, oh, okay, this is awesome.
Yeah. And don't expect your CPA to be able to know about this or
They can't know
help
every
you.
little nuance. Yeah.
They don't have time to deal with
Yeah.
strategy.
Exactly.
Okay?
Exactly.
Most of them are just doing tax filings.
Yeah.
Okay. And maybe you're accounting every month or something. So
Yeah.
this is just, something that to be concerned about or be aware of, as you're moving forward. Okay.
Yep. And then let's go ahead and I'll stop interjecting as much so we can make sure we get through the next couple of these.
Okay. All right. So fully using what's available to you increases your cash flow tremendously. I mean, like I said, I'm, understanding all of this, you're probably going to end up with, I would say, between 8 and 10% or more of what you paid for that building in tax benefits you didn't even know you had. Okay. And all of these extra things that I talked about, like partial asset disposition, and there are other things too, but all of these are based upon the initial cost segregation study. So getting a good, solid engineering-based cost segregation study is going to help you going forward. Okay.
That's your foundation, and then that's where everything else stacks up. Awesome.
That's right. Okay. And you can move it forward. Okay. So there are ways of also doing look backs for items that, how would I put this, that in years past were capitalized on your depreciation schedule. And this can go back 20 years. I mean, it doesn't matter how long you've owned the property. If you've done a lot of renovations over the years, a lot of things that were capitalized in the past now can be expensed. So we can do a look back study on these and do a CapEx reversal, which means that what was capitalized before, we can now expense. So it gives you tremendous benefits. I did a series of fast food restaurants, and the tax expenses alone that they could write off was well over $1 million. Okay, so, and this is not doing a new cost seg study. Okay,
Yep.
This was a look back of things that were done in years past. So, you know, some of your expenditures will have to stay capitalized if it's a permanent thing. But we can determine that and be able to expense a lot of the things that may have been capitalized and is on your depreciation schedule now that doesn't need to be there anymore. Okay. Okay. So if a repair keeps a building structure and building in its efficient operating condition, okay, then it's keeping it in operation, which is a renovation. It's usually an expense. If it's putting it in service, like operating, let's say, putting in all those 8 air conditioning units in that vet center, they do all at once, it has to be capitalized because it's putting it in service. It's not a repair.
Mm-hmm.
We're replacing 1/3 of those is an expense. So
And is a third, was that specific to HVAC, or are there different percentages associated with different types? Like the roof was 40%?
Yes, most of it is 35%. Okay. If you're doing it and it's, you know, but at the same time, if you are, let's see, a lot of times instead of replacing like an HVAC system, you're going in and you're doing major repairs. It's still a repair. It's not replacing it. And it shouldn't be capitalized. It should be expensed. So those are the things that we look at when we're looking at, you know, looking back or looking at what you're doing now. You know, if you want to keep a particular HVAC system, if it just needs repairing, it's going to save you some tax money.
This reminds me so much of permitting, to where we go in and we say, you know, we're just doing a face replacement of a sign, or we're just changing out to where we're repairing, to where we don't need a permit and we don't lose all of that time in permitting. So yeah, very similar strategy of, is this a repair or a replacement to where you're doing something new? Very cool.
Okay, you can move it forward.
All right. Well, actually, since we're running short on time, let's go straight to cost segregation sample studies to kind of go into the weeds a little bit on that. And then I definitely want to get to that zip tape.
Okay, all right. This is a self-storage unit, was purchased in 2017. So the tax savings on this for $859,000 purchase, almost $860,000. Their tax savings was $45,000. That's tax savings. In other words, taxes they don't have to pay. Now, if you can't use it all in the first year, you can roll it forward year after year. There's no end. You use it until it's used up. So the first year, you may not have any taxes to pay at all. Okay. A dental office, medical facilities are incredible as far as the tax benefits available, because they have so much that can be depreciated up front. The cabinetry, the special equipment, the walls, some of the walls even in major renovations, and I'll get into this later, but the walls can be changed from being capitalized items to actually depreciated up front. But I'll get into that in a bit. But all of this stuff you see in here for dental offices is up front. Now, these improvements that they made on this, they purchased $1 million, just the shell of the building. Okay, They put 450,000 in the improvements. This dentist's office saved him $74,000 in taxes. Okay. And that wasn't even with 100% bonus depreciation because it was done in 2008. Okay.
Okay.
Or purchased in 2008. Okay. So apartment building. Okay. The construction of this apartment complex was 1.2 million. Tax savings, 63,000 in taxes they didn't have to pay. Okay. So this is what you're missing if you're buying and you're not doing this. Okay. Now, I would recommend that you get it done the first year, because if you don't do it the first year, then you've got an extra expense because we have to include a 3115 to change your accounting method from straight line to accelerated. Okay. Multiple office complexes. There were 12 locations. Some purchased back as far as 1999. Deduction, 5.3 million. Save them 2.1 million in taxes they didn't have to pay.
I love
They
real
wouldn't have
estate.
gotten that if they didn't do the study. Okay, you can go to the next one. Okay. So 179D is really about upgrading a commercial property by putting in energy efficient HVAC systems and other items. So it applies to commercial buildings, multifamily residential buildings, industrials, even parking garages. Okay, we can't do cost segregation on parking garages, but 179D will get you big tax deductions with this method of tax benefits available. And
you
some
said
CPAs will say, oh, we've got it.
multifamily.
Go ahead.
Go ahead. I was going to say, what's the smallest multifamily? Is that 5 units or more than for commercial?
Yes.
Okay.
Yeah. Yeah. A lot of CPAs or tax pros will tell you, oh, we need to do an leads study for leads credits prior to doing the 179D. That's a misconception out there. You do not have to do the leads credits prior to doing a 179D.
Okay.
Okay. You can turn it. Okay. Next item is R&D development taxes. This we also offer. Research and development applies to a lot of industries that you may not even have at top of your mind. I mean, who would think of a food company being able to take advantage of government research and development tax? Okay. There are a lot of companies out there, even in the food industry, who are experimenting with new combinations to do plant-based items because a lot of people are getting away from eating so much meat for health reasons. So the industries qualifying could be food and beverage, medical. Most people think of tech and software as research and development, but that's not all. I've had some companies that their entire focus is on nothing but research and development. They research and development. If it works, then they send it to somebody to commercially develop it. Okay. But year after year, they apply for the R&D credits and they continue their business because they've got credits year after year after year.
And this would apply to so the construction industry is obviously very old and hasn't been super innovative, but things like modular and things like different panel systems and so those would all, and we need that. So that's awesome.
Yeah. If they're doing the research on something and they're developing out a new way of doing something or building it, then let's talk.
All right. Love it.
Okay.
Well, let's finish this up with a green zip tape then. This is my new favorite thing to know about.
I love green zip tape. Okay. This is a product that is available for ground up construction or major remodels. We're talking $10 million buildings and up. Okay. If they use this green zip tape, which is patented, And we work with you on this. Okay. We are actually the only company that can give you this because we have it approved by the IRS. So we've had a lot of companies already that we've worked with, big companies, Koch brothers, CBRE, Chevron, Staybridge, Bank of America, even Embassy Suites have all done this in their new construction. Because what happens is that it saves 5 to 10% of what their construction costs are. That's huge. And if you can get it in, talk to us at the design stage with the architect in particular. We can design it in at the very start. Otherwise, we can also do it if the project has not had the drywall installed yet. But
And then what's the range of types of projects again? So they can know.
It's primarily we're looking at multifamilies, large multifamilies. It could also be, let's see, let's say you're taking a hotel and you're totally demolishing the inside, turning it into apartments, or short-term rentals or whatever you're going to do with it. That can also qualify. Think in terms of drywall. If this property has a lot of drywall and you're doing the construction or major reconstruction and it's a $10 million property or more, sometimes even less than that if there's a lot of drywall. Medical buildings in particular are incredible for this because hospitals don't like dust flying around. They don't like the contaminants. When they go in there with sledgehammers, bust out that drywall, and it fills up our landfills. This is reusable, and it makes even the plumbing and electrical that's behind that wall depreciable up front. So it turns capitalized walls into 5-year depreciable up front. And with bonus depreciation, you even get that the first year.
That is awesome.
It's incredible. You're looking at $10 to $15 a square foot in tax benefits.
Love it.
So
love it.
You know, $1 million on $10 million property in tax benefits.
It's not something to stick your nose up at. Awesome.
That's right.
Well, thank you so much, Bonnie, for being here and sharing this. And we'll be sharing this in our community and put the replay out to some people. But here is Bonnie's contact information if you guys want it. She is a wealth of knowledge. I mean, just like she shared today, and can help you guys out on anything. So we did run a little bit long. So let's just go ahead and give you guys the QR code to. If you guys are interested and you want to pursue local real estate development and employ some of these cool strategies into your projects, we have the retail price of $197 for our course. But for you guys today, you can actually use our special offer. They get you 50% off. So you get the full blueprint course that's 4 to 6 hours, self-paced, and comes with all of these checklists, templates, case studies, insights, and tips. And we did launch our community. So our community is live, and anyone who purchases the blueprint course gets in there for free, because we want to build a community of people who are transforming your communities and are taking those neglected properties and turning them into awesome new spaces. And the best way we found to do it is just to be sharing what we've learned and interact with everyone to get comfortable and go, oh, that's what Sarah's doing over in Wisconsin. I'm going to try that down in Tennessee. And then maybe someone in Texas does something. So super excited about that. So definitely take advantage of our blueprint course and community. And I think our code is on the next page. The code for this month is LRED, LRED September, SEPT 50, and that'll give you your code. So awesome. Thank you guys. Bonnie, thank you so much for your time. We will definitely be sharing your information and sending it out, as well as posting this and giving you a copy. So thank you so much for being here.
Well, thank you for inviting me, and I look forward to hearing from people. Just be sure to tell me that you heard it on Kristi's podcast or Kristi's presentation. Thank you very much.
Awesome.
Okay.
Sounds good. Thank you guys. All right.
Have a good day.
Have a good rest of
everybody.
your day.